Welcome back to the Dividend Diplomats YouTube channel. You know you've got Bert and Lanny, the diplomats here, guys, the best dividend investing YouTube channel on the network here. And we're talking about two stocks that you guys wanted us to cover on today's video, baby.
Yeah, what's that, Lanny? I hear Andre who? Graham Stephen who? We're talking the diplomats right here, right today, right now. That's a warning shot for the two of you, so you guys better watch out. We'll see you both at WrestleMania. All right, everybody. But on that note, if you haven't already, subscribe to our channel. Give our video a thumbs up. Everyone, the support's been appreciated. Let's try. We've pushed so hard to get to 15,000 subscribers. Let's see how quickly we can get to 20,000. That would be awesome. So thank you for your support. But man, Lanny, this was one heck of a week in the stock market, wasn't it?
I tell you what, it was. Well, first, obviously, on the crypto side, FTX collapsing. Crypto is faltering right now. BlockFi is halting withdrawals as well.
The Voyager rescue that was is no more, and now they're back out to bid.
Right. And then the S&P 500, like you said, was up on the week about 5.5% to 6%. You know, with the inflation numbers coming back better than anticipated right now. Obviously, when the Fed continues to increase interest rates, that's part of what their solution was because of it. And with that, the Fed increase in interest rates could be a little bit lower and slower to come over the next 6 months or so, with maybe some tapering of interest rates come, maybe the second quarter, third quarter of next year. So the market really responded to that favorably.
Excellent summary, Lanny. And I think the important thing is through all of this is whether it's good times, good weeks, bad weeks, red jacket, blue jacket, green jacket, it doesn't matter. We're always on the hunt for undervalued dividend growth stocks to buy. We don't try to time the market. We look, we run the numbers, and when it makes sense to buy the stock based on the metrics, that's when we buy. So still, despite this massive increase in the stock market, despite this green week that has to be one of the best I've seen in years, we still found some undervalued stocks for all of us to consider. And that's what we're going to talk about in this video today.
That's right. And we're going to swing into retail, guys. I know the one commenter that we had on one of our last videos really wanted to put Kontoor Brands and Levi Strauss into the dividend investing ring, two kind of retail brand-oriented companies here. Obviously, they don't really have many physical stores, but their products are in many stores, many channels, online channels, Macy's, Kohl's, you name it. They're kind of all over the place in terms of where you can find their product. And me and Bert, These two companies had a rough 52 weeks. Obviously, if you take out the last week, but both stocks are down 30 to 40% in the last year.
Yeah, and it's going to be fun to analyze these companies because we put retail on the back burner for a little bit. We're always talking about them. It's been a long time, so let's bring them back to the front burner. Kontoor Brands, just to give a quick background here, their main brands, Wrangler, Lee, Rock, and Republic. And if you really aren't familiar with the name Kontoor Brands, they're a relatively new entity because they were spun off from the Dividend Aristocrat. Wait, are they Dividend King, Lanny? VF Corp, ticker symbol VFC.
Well, we'll have to check back into that. But yeah, they have had a history of growing dividends prior to the spinoff into KTB. But kind of like Abbott and AbbVie, we don't really consider them a dividend aristocrat because they are now on their own.
Right. And Levi, we all know Levi, their brands, Levi, obviously, Dockers, Denison, Signature, and Beyond Yoga are some of them. So as you can see, the brands are pretty head to head when you look at them. So this is a true apples to apples comparison between the companies.
Yeah, I would say this is a very clean dividend stock analysis. Both are actually performing surprisingly well in 2022. When you look at the 9 months through September year to date of 2022 to September of 21 year to date. So again, both companies are performing well because Kontoor Brands, their net income was at 194 million through 9 months. That's actually up against their 152 million they earned through 2021's 9 months. And Bert, how is Levi performing financially as well through the first 9 months this year from a performance standpoint?
Very strong. 9 months, $418 million versus 409. So same metrics, same great results here for Levi. I think both companies are doing very well.
We're going to put them through then the Dividend Diplomat stock screener that's focused on the three metrics we look at. One is the price to earnings ratio, two is the dividend payout ratio, and three is that dividend growth. We'll throw in the dividend yield, guys, but we're going to get right into it here so we can give you the information quicker, sooner, robust. For what is Kontoor Brands looking like right now on that first dividend stock metric?
Price a flat $41 per share. Forward EPS $4.35. That PE ratio 9.43, below 10. Single digit PE ratio. No, not too bad at all.
So to look at that second metric, the dividend payout ratio, where we like to see 40 to 60%, Kontoor Brands is actually right in that sweet spot at 44%, paying $1.92 per share per year, 48 cents per share per quarter. So again, a 44% payout ratio, safe, room to grow, and they're reinvesting plenty of earnings back into the business.
So they don't necessarily have a 5-year dividend growth rate because they're a new entity. They've increased that dividend for 2 years, but when you evaluate the 5-year growth rate as reported on some websites, it's 9.67%. They're growing that dividend. They're playing some catch up here as this new entity. We've seen this before when a company gets spun off. High dividend growth start as they figure out their earnings, their cash flow, and then it kind of tapers off into what a more normalized average would be. Kontoor in that high growth area. That's why you see a growth rate of 9.67%.
Yeah. Again, the last increase went from 46 to 48 cents. So again, as Bert said, it's slower growth there, especially during this supply chain, impacted and higher inflation with lower spending dollars by the consumer. Played it conservative, a 2-cent increase this year. And then to talk about the dividend yield, which is how much this stock will pay you if you own it. You take that $1.92 and you divide it by the 41, dollars per share. You've got a dividend yield of, it's pretty solid at 4.68%. So you could argue that it's about, almost 3 times the S&P 500 right now. Definitely still higher than your high yield savings account. So again, every $100 you invest into Kontoor Brands, you would get $4.68.
Let's summarize here, Kontoor. PE 9.43, payout 44%, 5-year dividend growth rate 9.67%, but they've only been increasing that dividend for 2 years since that spinoff. Dividend yield 4.68%, and the performance, they are down 20% year to date, down 31%, 52-week. Here's the big question though. How is Levi going to stack up against Kontoor? Lan, you want to kick off the Levi side of this analysis?
Let's kick it off. Let's kick off and try to wrap up the battle of the denim here. Levi, ticker symbol, Levi, Levi. It's great.
I love it. I love it.
Yeah. But I'm surprised it's not in your portfolio yet then.
I know I only buy stocks that have tickers that match the company's name.
The stock price at the time of the video, $16.32. Again, down about 34% this year, down 41% in the last 52 weeks. The earnings expectations right now going into next year is $1.42. So the price to earnings ratio is at 11.49 times current projected earnings, which is slightly higher than Kontoor Brands.
Their annual dividend for Levi is 48 cents. That payout ratio is 33.8%, which obviously crushes our stock screener, slightly below Kontoor's payout ratio of 44%. But in our eyes, both companies have great, solid, safe dividend payout ratios.
Exactly. Now let's talk about dividend growth. Levi's got a little bit of a different story here. In the middle of the pandemic, they actually suspended their dividend at one point, and then they brought it back, starting at Q1 of 2021. So I think February time period. And not only did they come back, though, they actually came back at half of where they were. They were at about 8 cents prior to the pandemic. So then they came back at 4. So dividend growth history is a little bit interesting. They've actually increased the dividend, quite a few times already. They've gone from 4 cents to 6 cents to 8 cents to 10 cents to 12 cents. So guys, they've increased their dividend 4 times in 2 years. And not only have they done that, but now they're back higher than their pre-pandemic rate.
Growth. You can say there's growth now, finally.
So there's growth. We will say that they've been increasing it for 2 years, and again, if you actually, boil it down, I guess you could argue that the dividend growth rate is a little high. But I still think it's kind of like, you can't really discuss the growth rate because they're still trying to climb back.
That's fair. Sorry. I don't know why I find that so funny, but they're on the realty income plan of increasing their dividend every single quarter. It seems like as they climb out of that pandemic hole. Let's look at the yield. Dividend yield 2.94%. So obviously significantly lower than Kontoor's 4.68%. Still beats the S&P 500, but interestingly, that's actually in line with some high yield savings accounts now because of how much those continue to crush it. SoFi, say 3% is at that dividend yield.
Yep. So guys, in summary, Levi, 11.49 price to earnings ratio, a very safe dividend payout ratio at 34%, 2 years of growing their dividend at a very high rate. But it's, to me, I still think can't really discuss growth rate right there because they cut it, resumed it, increased it. It's kind of interesting. Yield of 2.94%, down 41% in the last 52 weeks. And keep in mind, this company has got a market capitalization of about 6.4 billion, and that's versus Kontoor Brands at 2.27 billion. And we'll put up the charts of both companies right now side by side so you can compare the two dividend stocks.
So here's the question, Lanny. We know your closet's lined with Canadian tuxedos. The question is your portfolio going to be lined with these two denim companies?
That's a great question. I've historically have stayed away from this industry in particular, just in the brand wear. I never owned VF Corp, never owned Kohl's or Macy's. I dabbled in with Bed Bath & Beyond. It was my one taste of retail, and I did not like how it tasted.
That's a tough pill to swallow.
Yeah. Again, very different industry, though. Obviously.
All your registry gifts are denim jeans that you're sending to people.
I'm probably not buying any of these two stocks, but if you really wanted to own, if you enjoyed the brands, performance there is there. They're safe. Metrics are looking solid. If you were to do this, again, do your own research, but it could be a small position in a portfolio.
Yeah. I mean, I really have nothing more to add. I agree with everything you said about the conclusion. I'm staying away, but they're not bad starter ones if you want to dabble into retail. Everyone, let us know what you think of Kontoor, what you think of Levi. Do you like one, both, or are you like us and just staying away from them today? If you haven't already, you know what everyone needs to do before this video runs out. Subscribe to that channel. Give this video a nice thumbs up, everybody. Lanny, is there anything else you want to add?
Guys, keep investing, keep building that passive income stream. Let's get to financial freedom. Thanks for riding with us. And again, you're either with us or you're against us. That was Bertha, Hurt, and Lanny from the Dividend Diplomats. Over and out.